to me, the more fascinating part of your question is how do you deal with a bubble like 2000 where a strict disciplined valuation approach to investing just says none of these names make sense to us, we can't figure out the values. And how do you keep people invested with you when you're holding the line that says these names just don't make sense? The Oakmark Fund assets peaked at about $10 billion in 1997, 98. And even though our net asset value had been about flat for the following 2 years, our assets were down to $2 billion. Because we refused to buy anything in the technology space, people took 80% of the investments away from us. And that's a tremendously difficult time when you're running a business and you've got people to employ that you want to have continue with you and you're seeing your revenues fall by 80%. But I remember a conference call I was on, one of the advisors who was in the process of selling out of the fund was pleading with me saying, won't you please just own one technology stock? Because if you buy one of them, then I can go back to my investment committee and tell them that's okay. And I remember saying to her, I said, if we could find one that fit our value criteria, we'd happily own it, but we can't. And because of that, we won't. I said, and I'll bet you something else. There's going to be a time in the future that you're going to say, it's not that Oakmark's incapable of buying technology, but when technology is out of favor, we're going to own more than the market weighting in it. And I said, you're probably going to be just as upset with us then as you are now, because we're investing in something then that would be unpopular. And it's tough, but if you don't stick to your discipline, there was a Chicago firm that was known more for growth investing that was still a pretty strong fundamental value firm, but they applied it to growth stocks. And about February of 2000, they threw in the towel and said, we've lost too many of our investors. We're going to start buying these very high-priced internet names, even though they don't work under the way we used to invest. So they didn't ride the market up. They rode it all the way down, and it put their firm out of business. You mentioned earlier, I was named Morningstar Manager of the Year in 2001. It wasn't that we did anything different in 2001 than we did in 2000 or 99 or 98. It was the market suddenly corrected valuation excesses, and the traditional companies we'd owned through this whole period went up in price significantly while all the tech names came crashing down. But it was the discipline to say, we're going to keep doing the same thing. And we know if we're fundamentally right on the analysis, the stock prices will eventually follow. And we're not going to try and placate investors who want to see us invest in the current bubble. I remember being on CNBC back then talking about how high-priced we thought technology names were. And I'd hopped into a cab on my way home from work, and I can see the cab driver looking in his rearview mirror. And he's like, hey, I think I know you. And I'm like, I kind of got my head down. I'm like, no, I don't think so. He's like, yeah, I do. I've seen you on TV. And I'm, maybe. He's like, you're that guy on CNBC. He's like, and my portfolio's kicking your butt. And I'm like, you know what? It's not that far to my house. Why don't you just drop me off here? I'll walk the rest of the way. But when things get that popular, it's very rare that they end up being good investments. And as long-term value investors, we get a lot of comfort from the history of seeing bubbles grow and bubbles pop. And the people who weather those bubbles well are the ones who had a philosophy that grounded them, and they didn't change it to reflect bubble level pricing.
Your stock's not moving, but the market is booming. Everyone's celebrating, except you. Should you sell or wait? Let's talk about why trusting your fundamental analysis might be the smartest decision. In the short term, markets are driven by sentiment, hype, fear, trends. But in the long run, it's the fundamentals that matter. A strong business won't always show quick price action. But given time, the market catches up. Price is what you pay, value is what you get. Many great stocks stayed flat for years before exploding. because fundamentals improved while price lagged. If the business is strong, the price will follow. For example, Bajaj Finance moved sideways from 2010 to 2013, but profits kept growing, and eventually it gave a 40x return. Infosys went through quiet years in the 2000s. Asian Paints was once a sleepy stock. But all had strong fundamentals, and that made all the difference. It's hard to stay patient when others are making quick gains. But compounding takes time, not speed. If the fundamentals are intact, your patience isn't weakness, it's your edge. Recheck your thesis. Is growth happening? Are earnings solid? If yes, stay put. Long-term investing rewards those who stay focused while others chase noise. The market may ignore a great stock today, but not forever. Believe in your research and give it time. Sometimes the best action is no action at all.